The Accountancy Paradigm Shift. This presentation addresses a major shift currently underway in the way accountancy services can play a key role in the growth and support of their clients. Disruptive technology and new business models are at the heart of this shift, but the tempo and scope of the shift will be driven by the acquisition and consolidation of the £8 trillion worth of businesses owned by retiring baby boomers worldwide. Companies wishing to grow aggressively through acquisition and consolidation will determine how and from whom these accountancy services are purchased. The failure by an accounting firm to recognize this shift and get in front of the growing wave is already resulting in the loss of clients, most notably their higher revenue clients. In other words, accountancy firms are losing clients, and in most cases, they do not know why or how to retain these clients. This is where National Diversified Funding Corporation can bridge the gap. National Diversified Funding Corporation, NDFC, is a private equity company that partners with accounting firms worldwide. We provide programs which allow accountancy firms to have what is effectively their own in-house private equity and merger and acquisition arm, providing an array of growth services for their accountancy firm's clients, which lead to new revenue streams for the accounting firm. Perhaps more importantly, NDFC is a vehicle for accounting firms to capture as clients those companies who want to grow by acquisition, which means they become the natural choice for clients currently leaving other accountancy firms who cannot support their new growth plan. NDFC is a key resource in helping our accounting firm partners prosper in this area. This means new business and revenue models for your firm and your clients. The standard business model of an accounting firm and its typical revenue model has remained essentially the same for more than 100 years. The range of services offered have been relatively narrow. When you look at the day-to-day interaction between the accounting firm and their client, it is typically absent except between the fiscal year end and tax filing day. Accounting firms are typically passive with their marketing, waiting for clients to find them by word of mouth or accident. All of this is now in a rapidly accelerating state of change. The standard services to their business clients consist primarily of helping the clients set up their books and records, assembling relevant financial transaction data, production and review of financial statements, assistance in planning certain transactions to minimize tax liabilities as the law permits, preparation of tax returns, and assistance of clients with the Inland Revenue or IRS in the event of an audit. This is all well and good, and it is what the client expects from their accountant. During the annual review process, the accounting firm might assist the client in understanding the relevance of the information revealed by financial statements. But what seems to happen in many cases is the accounting firm leaves it up to the client to interpret the completed financials. Arguably, one of the major reasons most small businesses remain small is the owner's inability to understand the information available in financial statements, which makes scaling for growth virtually impossible. Larger accountancy firms also perform auditing services as a significant source of revenue. Small local firms, up to mid-sized regional firms, generally are not able to compete for audit revenue, especially for large clients with a national or international footprint. Your standard accounting firm basically charges hourly fees, and thus cannot leverage the time value of its partners or staff. Partners and staff exchange time for dollars in some relationship to their expertise. Leverage of time value has been mostly relegated to senior partners benefiting from the work performed by junior partners and non-partner personnel. During the last several decades, the main way large accounting firms grew was by acquisition and merger. The Big 8 became the Big 4. Of the Big 4, only Deloitte is a US-based firm. PwC and EY are UK-based, and KPMG is Netherlands-based. Growth was seen as a zero-sum game. In order to grow, an accounting firm had to take a client away from another accounting firm. Since mature clients rarely changed accounting firms, acquisition and merger was the accepted avenue to growth. Growth through acquisition and merger has now been mostly played out at the top, forcing a change in their business and revenue models. The new emphasis is to create new revenue streams from the existing clients by offering an ever-increasing array of consulting services aimed at helping clients increase revenue, decrease costs, improve cash flow, and facilitate raising debt and equity capital. Typically, small and mid-sized accounting firms have not had the resources to increase their service offerings, resulting in a layering into two tiers of accounting firms. Tier 1, those that just do typical accounting services, and Tier 2, those that leverage the relationship they enjoy with the client to create added revenue streams through providing client-appreciated growth services. The perception by small and mid-sized business owners that accounting firms are all essentially the same is now being broken down by those firms in Tier 2 who are wooing clients by a demonstration of their ability to help their clients grow their businesses. Most Tier 1 accounting firms now recognize the need to differentiate themselves in the marketplace. The most effective way to accomplish this is through offering additional services that help clients grow revenue, shrink costs, improve cash flow, and facilitate financing. Tier 1 accounting firms typically resist adjusting to the new business model essentially for four primary reasons. 1. Differing skill sets. Providing growth services to clients requires very different skill sets than providing typical accounting services. Sales and marketing, for example, is something that accountants have a great deal of difficulty with for themselves, never mind for their clients. 2. Lack of capital. Providing growth services to clients requires a significant capital investment given the nature and scope of these services and the time it takes between when the services are offered and when they produce revenue higher than the costs of providing them. The more sophisticated the service, the higher the supporting costs and the longer the time to profit. 3. Loss of control. The fear of losing control of their client, for example, makes it difficult for the accountant to introduce to their client a business coach who can guide the business owner through the growth process. 4. Resistance to change. The principles that have traditionally guided the growth of accounting practices are very different from the principles driving today's successful entrepreneurs. Many studies have been done profiling traits common to those individuals who pursue various career paths. Most of these studies assign the following traits as those most commonly found among accountants and people in a finance advisory role. These people are classically of an analytical personality style, which means A. High interest in details, facts, concepts, and methods. B. Make decisions slowly, based upon fact and logic. C. Tend to seek order and efficiency. D. High aptitude for creating standards, systems, protocols, and forms. E. Oriented to analysis of details and fact-finding. F. Highly risk-averse. G. Value expertise in themselves and others. H. Do not want to be wrong, with a high need to save face. I. Tend to measure progress by activity as opposed to results. J. Highly prone to procrastination. These traits are in many cases antithetical to their entrepreneurial clients seeking to grow their companies. The traits most commonly found among today's entrepreneurs are collectively known as a driver personality style, which includes A. High level of passion for their product, service, or field. B. Make decisions quickly, based upon fact and logic. C. Able to work in an unsettled environment where ground shifts constantly. D. A general dislike for details in favor of pursuit of the big picture. E. Oriented to push sales growth with less emphasis on enabling systems or cost saving. F. Open to risk taking. G. Bottom line, action, results oriented. H. Don't mind being wrong and pivot easily. I. Measure progress by results. J. Lack patience, want it done yesterday. In summary, accounting firms are reluctant to expand into services where 1. They have little or no expertise. 2. They have insufficient capital. 3. They don't want to be in a relationship where others can take or at least exert some degree of control over their client. 4. They have to overcome their own personal resistance to change and align more with the priorities that drive their entrepreneur clients. This can be difficult. And the challenges have not ended here. There is also the emergence of disruptive technology, which has been affecting the revenues of accounting firms worldwide. An example of this is emergence of software that automates and otherwise facilitates the business client's accounting needs. The result has been a reduction in the billing opportunities for many accounting firms, and these changes will be gaining more ground in the short term. For example, a major client relationship management platform, shopping cart, and office automation software provider with which our firm NDFC partners with is now also partnering with one of the most widely used bookkeeping and payroll software providers. Together, they seek to offer a seamless operating solution that fully integrates the two systems. Using this integrated system, an order taken electronically or manually will flow through every function, from outbound or inbound marketing, to order capture, to order fulfillment, through billing or charge to credit card, to receipt of funds through the entire accounting process, through production of the period's financial statements, through customer service and support. Payroll will be more automated than today, and even most customer and supplier interactions, such as collection emails, will be automated. Once set up, only occasional interim and period-end adjusting entries will be required by the user. While such an integrated system will be essential to facilitate client growth in a competitive marketplace, it requires a relatively sophisticated, well-trained operator. NDFC's role in this process is to make the accounting firm the center for implementation and interface between the software and their client, including the recruiting and training of accounting firms and clients' personnel. NDFC has the resources to carry accounting firms through this disruptive technology paradigm shift. Instead of continuing to lose revenue to the disruptive technology, NDFC is expanding the revenue model for accounting firms by making them the distribution and administrative centers for that technology. NDFC also provides the accounting firm and the client access to the funding necessary to implement the changeover. So, let's talk about demographics and who will be affected by this opportunity. Well, first of all, it is an opportunity for accounting firm growth. Accounting firms can buy up competitor firms who are struggling because they have not adapted to the change, or firms with partners retiring. The aging of the baby boom generation represents an unparalleled opportunity for growth-oriented accounting firms. The quickest and least risky way for an accounting firm to grow is to acquire the practices of retiring accountants. Where the acquiring firm has determined its desired geographical footprint, its areas of specialty, its optimal client profile, and target size for revenue and personnel, a strategic plan can produce the desired result by targeting among an abundance of accounting firms coming to market as their boomer owners retire. The first step of that strategic plan will be giving the accounting firm the resources to set themselves up as a platform that can quickly and cost-effectively target, approach, value, negotiate, finance, and absorb ideal acquisitions. NDFC provides its accounting firm partners with the resources to grow by acquisition, and to do so without the firm's accountant partners providing any of the capital. NDFC's proprietary financing sources and methods are only revealed to firms signing a non-binding expression of interest, EOI, but which does not include binding non-disclosure and non-circumvention provisions. This is also an opportunity for the accounting client's company growth. As with the accounting firm, certain business clients can also benefit from growth by acquisition. By having its own in-house merger and acquisition arm, the accounting firm partnering with National Diversified Funding has the opportunity to differentiate itself from its competition and actively facilitate its clients' growth. The table on the screen is provided only for illustrative purposes. It assumes that a company valued at $500,000 makes one or more acquisitions each year for 5 years of companies collectively equal in valuation to its valuation at the end of the prior year. For the next 5 years, acquisition values decline each year as a percentage of the value of the enterprise. It also assumes that the original company and its acquired companies achieve internal growth at the rate of 9% per year, which is conservative. While no simple progression would be an accurate forecast for the future, the table is useful in that it illustrates a realistic outcome of what could be accomplished during the coming period when baby boomer-owned businesses will be for sale in unprecedented numbers. As the acquiring company grows by acquisition, it becomes more and more capable in competing for the most desirable purchases. Through its partnering relationship with NDFC, the accounting firm offers the client services required for the strategic planning, structuring, and funding of the acquisitions, as well as the scaling required for each acquisition's integration and assimilation by the acquiring company. Through growth by acquisition, a $500,000 valuation company has the potential of achieving a valuation of over $500 million in 10 years. There is no other pathway besides growth by acquisition which can offer non-technology companies this level of growth potential. At some point, the company may be a candidate for an IPO, a public offering. An alternative could be the client itself is acquired by a major public corporation. So the question arises, will the client outgrow the accounting firm? If the client will require certified audits with a national or international scope, or if it is acquired by a larger company, it may well outgrow the accounting firm. However, NDFC offers the accounting firm the opportunity to participate in equity shares earned by NDFC as it propels the client's growth through acquisition. The equity stake held for the benefit of the accounting firm and its partners substantially outweighs an accounting firm's profit, which could be earned by performing the standard certified audits. So what does this all mean? It means new services and new revenue streams. Do you remember the Tier 2 accountancy firms? Large firms have the capital and scale to offer these types of business growth services to their clients. This gives them a distinct advantage, enabling them to outcompete smaller firms for lucrative growth-oriented small and mid-sized business clients. NDFC is a private equity company that backs entrepreneurs who want to grow by acquisition. We are positioned internationally with resources in the majority of industry sectors to facilitate a significant share of the £8 trillion wealth transfer from baby boom generation owners to Gen X and Y entrepreneurs. NDFC provides local and regional accounting firms with a white-labeled turnkey menu of service offerings that enable them to not only outcompete their peers, but go head-to-head with major firms and win. Then NDFC takes it a step further. We assist our accounting firm partners to acquire other practices using our proprietary no-cash structures and strategies. We also serve as a marketing arm, helping them build up their portfolio of growth-oriented company clients. If you are a local or regional accounting firm, here is why you should consider a partnering arrangement with NDFC. NDFC helps your firm generate more fee income. This means more clients paying higher fees to your accountancy firm. If you are the owner or the CEO of a company with annual revenues between $2 and $50 million, would you be more likely to choose an accounting firm which provided highly professional typical accounting services, or one that, in addition, provided growth capital? As your in-house private equity partner, NDFC can provide your qualified clients with rapid access to the cash and other growth resources they need. Acquisitions. As your in-house merger and acquisitions arm, NDFC can provide your qualified clients with the ability to buy other companies without using their own capital to fund the purchase. For your clients, that means competitor acquisitions for increased market share, leadership in their industry, or even dominance of their market space. Complementary product or service company acquisitions for increased revenues for both the acquired company and the acquiring company through cross-promotion and linked marketing to their respective customer bases. Supplier acquisitions for increased margins and more control over quality and delivery time. B2B customer acquisition for increased margins and higher sales volume with more control over the distribution process. Toehold acquisitions to open new markets quickly and efficiently. Blocker acquisitions to deny competitors access to technology, geographical access, or other key ingredients necessary to be a viable competitor. Economies of scale acquisitions that enable higher levels of efficiency and effectiveness, better utilization of capital, and higher profit margins. Enhanced exit options. As your in-house merger and acquisition arm, NDFC can provide your qualified clients with the ability to optimize the value of their company on sale with a guaranteed buyer at a guaranteed pricing at the time they're wanting to retire through NDFC's proprietary build-up buyout structure. Succession planning and funding. As your in-house merger and acquisition arm, NDFC can provide your qualified clients with the ability to retain their company in the family in the face of high estate taxes. More clients. Brought to your door by NDFC's practice development team, you can make up a wish list of ideal clients who now use other accounting firms. NDFC then helps you to invite their decision makers to attend a live seminar or webinar to learn how they can grow exponentially by acquiring great companies coming for sale in unprecedented numbers by the retiring baby boomer owners, where NDFC provides the needed know-how and capital. NDFC's seminar/webinar leaders are not only M&A experts, they are experts in migrating these companies to become your and NDFC's collective clients. More per client income. From added high-margin client services where NDFC either shares its revenue with you or, at your option, hires your firm to provide much of the needed man-hours. Expansion of your accounting firm into lucrative business mergers and acquisitions where NDFC either shares its revenue with you or, at your option, hires your firm to provide much of the needed man-hours. What if your firm already offers its clients an array of growth-related services? This is great news. It means that you are more in the Tier 2 category of accountancy firms. But maybe there is one exception to the services you provide. You can simply choose only the services from our complete menu that you want to add to the service offerings you may already provide. The one exception is most probably mergers and acquisitions with private equity. This is our core business. Everything else we do flows from here. What about exclusivity? We presently limit the number of accounting firms we work with depending upon the size of the firms and the population base of the markets they serve. Exclusivity is possible within a defined market space based upon the client profile and performance capabilities of the accounting firm. So, what are the requirements to qualify as a National Diversified Funding Corporation accounting firm partner? Qualification differs according to the size and sophistication of the service area and the number and type of business entities registered in the marketplace. In general, however, NDFC partners with firms that have been in practice for at least 7 years, where the firm is growth-oriented with a strong, verifiable reputation for community service, integrity, professionalism, and which has a great rapport with local lenders and investors. Another key qualification is the firm's practice is business-oriented, with a solid experience of working with clients in the £1.5 million to £35 million sales range. How can you get more information about National Diversified Funding Corporation and its Accountant Partnering System, APS? For more information on how NDFC can help you build your accounting practice, contact your nearest NDFC office for your country using the contact page on our website, www.nationaldiversified.com. Or if you are receiving this as a free recorded message and you have questions or comments, please leave your name and telephone number after the tone. I will return your call promptly.